What's going on, everybody? This is Austin with Austin Smith Real Estate, and today I wanted to talk about how to buy an investment property, how to buy your next investment property. What are the type of financing techniques that you can use? If you have no money, where can you get the money from? All different tricks to the trade, but going to discuss how we can buy our next investment property. 2019 is January already, but we have the rest of the year to accomplish these goals for anybody that's looking to go after their next investment property. And as a reaffirmation to myself and my partner, there are a plethora of ways that you can raise money, find money to invest in real estate and go after that next investment property. So right off the bat, we'll talk about the four primary funding types or loan. We'll talk about the four primary loans that there are that you can kind of go after and invest in real estate. And then we'll talk about where the cash can come from in order to go after the four different funding types, lending programs that are out there. But we'll jump right into it. The first way that you can go after your next investment property is purchasing it with a conventional loan. Conventional loans usually offer the best rates, the best terms. You usually have to have a higher credit score than FHA, which is number 2. But going after your conventional loan, if it's your first property, then you're able to put down as low as 5%. And if this is your second property, then you might have to put down at least 15 or 20%, most likely 20%. And some lenders will go as even high as 25%. So that's why your first investment property or the first property that you purchase, it's a lot easier to purchase an investment property when it's your first property than purchasing it after your first home. So using a conventional loan, that is going straight to your bank, straight to a lending company, filling out the application and getting pre-approved for a conventional loan, and you're off to the races. And the second one is FHA, which, pre-approval wise, FHA and your conventional loan are going to be virtually the same as far as what it takes, going after your pre-approval. With FHA, you have the infamous 3.5% down, 3.5% down, which a lot of first-time homeowners choose to go after, and you can't beat that anywhere. And if you have a girlfriend that you think is serious, a business partner, fiance, wife, and you don't own a property yet, it's best to get one property in each person's name so that way you're able to take advantage of the 3.5% down twice. There's also ways that you can continue purchasing FHA properties, but we'll save that for another video. And like I said, for conventional, if it's your first time, you're looking at 5% down. Anything after that, you're looking at 15, 20, 25%, but an average of 20% after. So you'll see how hard it is to go after another investment property when using a conventional loan, because they'll require 20% down payment. On the $200,000 home, that's $40,000. Take the same $200,000 home and apply a 3.5% down payment. That's about $7,500, I believe it is the correct number. Don't judge my math. I'm doing this on the fly. 3% of 200,000 is 6,000. So 3.5% on the 200,000, I'm pretty sure 7,500. Don't quote me on that. But you can see the difference. I mean, you're talking around $33,000, $32,500 difference between the 3.5% down and then the 20% that you have to do if you choose not to go after the investment property with your conventional loan on the first go around. So these two are your standard loan packages. Like whether you choose to go after an investment property or like a single family home, you're usually purchasing either FHA or conventional. So there's no problem with using these particular loan products to go after investment property. Keep in mind that these are more suited for buy and hold scenarios or rental properties. If you're using conventional or FHA for, say, a flip, then you're going to be incurring those monthly mortgage payments as part of your holding costs from the moment that you close on the property, do the rehab, and then sell it. You're doing monthly mortgage payments all in between. There's loan programs, which we'll talk about in a little bit, that will only charge you interest only, which is a lot cheaper. And obviously, if you buy the property all cash, you don't have to worry about any of this. But there's a plethora of ways why I would never buy a property all cash. Even if you take $200,000, you can split that up and maybe go after 3 or 4 income-producing properties, rather just sinking in your entire funds that are available into one property. Does that make sense? So these you're always able to use. And FHA, once you use your first FHA credit, in theory, you're not allowed to use another. Conventional will allow you to go up to maybe 5, 7 loans under one person's name. But you'll just have to go to the bank and see what you are able to qualify for. So conventional, FHA, your standard, like I said, these are better for buy and hold scenarios, not necessarily flips, because you have to be in and out with flips and keep your expenses low as possible. And with conventional FHA, paying that monthly mortgage payment, I mean, you can rack up thousands and thousands of dollars, which can eat into your net profit. So that leads me to go into more of the creative financing ways. And mind you, here's another important part. Conventional and FHA are tied to your personal credit report. So they're going to show up on your credit history, and they're going to be under your name. And to qualify for these loan programs, you're going to have to show the income. You're going to have to show the credit. You're going to have to make sure that all your financial ducks are in a row. The mortgage company, when you're going through the process before closing, because normally for these particular loans, it's going to take about 30 to 45 days to close, because the banks are going to be asking for a ton of information that they need from you. Your bank statements, your employment verification. We want to see the last 2 checks. We want to know where this amount came from. We want to know your firstborn son's name. We want to know everything under the sun, and that what causes the delay or the lag in between filing for the application and then closing. So those are those 2 things just to keep in mind. Then we have, what most of us know about but don't really know about, hard money. Hard money. Now, these are private institutions where the lending criteria is a little bit less strict than your conventional FHA. Hard money is based off of asset-based lending. So if you have an amazing deal, and even if your credit is terrible, you still have a chance of getting financing for that particular property because the deal is so good. The lenders here, they just want to make money. And if you bring them a deal that makes sense, they're willing to lend on it. They only care about the asset itself. They'll take a peek at your credit just to get a financial profile for you. They'll look at your income just as collateral. They'll look at certain things, but they really are not putting in that much weight versus your conventional or your FHA lenders. Now, what's the cost of doing business? Hard money is going to cost you a lot more. So your interest rates are going to be higher. Your points, which are your origination fees, any type of miscellaneous fees, are going to be a lot higher. That's just the cost of doing business. Usually hard money lenders, they'll request a certain, so for example, Conventional loans, FHA, they both have their own renovation loan package that you can go after. There's home style for a conventional, 203K for FHA, which allows you to roll, but both programs allows you to roll the renovation money on top of the mortgage, and then you pay the down payment on that total amount, right? So say if you need $150,000 for the purchase price, $50,000 for repairs, you're paying your down payment on the $200,000. Hard money is totally different. They'll usually only require a percentage as a down payment for the purchase price, and they usually fund you 100% of the renovation costs. So same scenario, 150 purchase price, $50,000 renovation. They'll only charge you the down payment on the $150,000 purchase price. And usually those down payments, kind of similar to conventional FHA. You have 5% down payment all the way up to, say, 25% down payment and everything in between. Now, they'll look at certain scenarios like how experienced are you? If this is your 15th flip, then maybe they might offer you a 5% down payment option or 10% down payment option. But do you see how with conventional, they automatically make you, first off, after you use the FHA, you might not be able to get a new one. With conventional, once you go after that second property or that third, 20% guaranteed. Makes it a lot harder. But in experience, and if you bring a great deal, hard money lenders will say, hey, listen, this is a great deal. We need to make some money off of it. You have the experience. Your credit is pretty decent. Hey, we'll lend it to you. We'll do 5% down payment. We'll fund 95% of the purchase price, 100% of the rehab. No problem. All good. The only thing to keep in mind is that the purchase price and the rehab can't exceed above a certain percentage of the after repair value. So say, for example, if the purchase price was $100,000, you put $50,000 into it, and the ARV, so all in, your purchase and rehab is $150,000, your all in is $150,000, and the ARV, the after repair value, the value that it's worth after you've done all the renovations, say if that's $300,000, you're all in for $150,000, the ARV is $300,000, you are now looking at a 50% loan to value in theory. So hard money, they'll never allow you to go above, say, 75% of the ARV. So you're all in, your purchase and your rehab can't exceed 75% of that after repair value. All right. Most lenders will hover around 70%. Some will even go as low as 65%, which will make it, a little bit harder for you to obtain funding. The higher the loan to value that they accept, for example, if they accept 75%, that's going to be a lot easier financing than if they were to only require 65%. Because then your purchase and your rehab have to be a lot better. Your purchase and your rehab, as well as the ARV, have to be in alignment with whatever the hard money lender is asking for. So 65% to about 75%. LTV is the acronym for it, and that stands for loan to value. So in other words, if you have a $300,000, if the ARV is $300,000, the lender is, your hard money lender is not going to give you more than 75%. So you can get up to 75% of that ARV. That's a good thing. 65% makes it a lot harder. It makes the numbers a lot tighter. All right. So with the fees that are involved, the interest that is involved, all in, you can't exceed the threshold, whichever particular lender sets it, You can't exceed that threshold. The good part about hard money is that people can close in 2 weeks. Now, when you're thinking about investment properties, especially if it's a bomb deal, if it's one of those deals that is a home run, chances are you're probably not going to be the only one that's going after that property. Hopefully you establish, if you're talking with the seller by themselves, then yes, you would be the only one. But the seller might be like, listen, we're only entertaining cash offers and we want to close in 2 weeks. With conventional FHA or FHA, you might not be able to close that quickly, especially if you're doing 203K. You have to have inspectors come out. They have to double check the work, triple check the work, send that over to the appraiser, You're increasing your lag time. When you're dealing directly with hard money, they can close it as quickly as 2 weeks. I've even heard hard money lenders being able to close in as early as 1 week, 5 days. Money can move a lot faster, and you can get money in your pocket to fund the awesome deals, so that way you don't lose out on the opportunity. So that's hard money. And the last one is private money. Private money. Now, most real estate professionals, they'll say private money and they'll interchange them. They'll use the word interchangeably between hard money, conventional FHA, private money, yada, yada, yada. Private money, for me at least, is when you are able to, say, for example, if you grabbed 10 people and each person put up $10,000, now you're dealing with $100,000 that you can now use at your disposal. But you see how the lending terms isn't as systematic as, say, running with a hard money lender or using FHA or using conventional, where they're tapping into your credit, tapping into your income history, making sure your ducks are in a row. Private money is money that's raised from your own sphere of influence. Maybe it might be your business partner. Maybe it might be your dentist and they were thinking about getting into real estate. Private money has a lot less flexible terms, or is a lot more flexible with their terms than these other options. Private money is always the best money because while your hard money lender might charge you 9% interest, 10% interest. Private money, if everybody's putting money into the pot, who has to worry about interest? You're flipping your own money. You see how that works? So private money is also always the best money. Or say, for example, if your dentist were to come to you and say, listen, I've been thinking about investing in real estate. I got $200,000. Can you make something happen for me? Well, you know that your purchase price and your rehab can't exceed $200,000. I mean, a little bit less than that to equate for fees and holding costs such as taxes or insurance and things like that. But you have a pretty penny to play with. And your dentist might say, you know what? I'll give you the $200,000. I won't charge interest. Just when you flip it, and if we make 50%, when you flip it, we'll split it 50-50. Awesome. You now was able to get into a deal, no income history, no credit history, just a personal relationship with you and your dentist. Could you imagine if your dentist saw you on social media just banging out rehab after rehab after rehab, doing successful deal after deal after deal after deal after deal? You think they care about your income or your credit? They seen you do deal after deal after deal. So it's a lot easier for them to trust you with their money. It might not be $200,000 at first. They might test the waters with $50,000. Fine, but eventually they might work up to $200,000. And at that point, they say, hey, listen, take the $200,000. When you flip it, we'll take half the profits. Cool, no problem. If you're refinancing and turning that property into a rental, then they might say, hey, listen, we want half the income profit or half the equity or whatever the stipulations are. But do you see how you have negotiating skill? Like you have the negotiating opportunity. You can speak with your private money lender and you're like, okay, well, instead of this, let's do this. So you can't really do that with hard money. You might be able to have a little flexibility especially if you develop the relationship with that hard money lender, but they're not going to, you can't haggle this 75%. You can't say, hey, listen, give me 100% of the LTV, or hey, fund me up to 85% of the LTV. Hey, I don't want to put no down payment. Give me the purchase price and the rehab, and we'll be all good. Doesn't work that way, right? And then one thing that I just want to backtrack on, 75% of the LTV. So 75% of the retail price, or what the property is going to be worth after, put it like this. Even if you're running your own analysis, even if you're working with a private money lender, you don't want to be far from this 75% value. And the reason why is because in theory, you want to buy properties at a discount. So if you're buying a property at, say, 65% of the after repair value, you got a real good deal. If you're buying it at 75%, you're buying it at a pretty decent deal. If you're buying at, say, 95, or if you're all in 95% of the ARV, then how are you going to make a profit? If your ARV is 300,000 and you're all in 95% of that, which might be, I don't know, 275,000, 280,000, whatever that number is, 200, whatever that number is, how are you going to make a profit if you do flip it? You got to pay the brokers. You got to pay your realty transfer tax fees. You might have holding costs in between from the moment that you close to the moment that you sell, all those costs in between. And now you're either, well, if you're leveraged at 85%, you're definitely losing money at that point. So that's just something to keep in mind in regards to LTV. But with private money, you don't have to worry about down payment. You don't have to worry about, well, I won't say you don't have to worry about. You're able to negotiate down payment. Your dentist might say, you know what, I'll give you $200,000. I want 10% down. And you're like, doc, listen, I've been coming to you for years. You done fixed every single cavity in my mouth. I'm banging out deal after deal after deal. Do 5% down payment. All right, cool, no problem. Cool. It's all negotiable. Or you might be able to say, listen, doc, I'm a beast at this. I got a bunch of people that are willing to just fund me money to find these deals. I'm only willing to work with people if they're willing to fund the purchase price and the rehab, and I'll cut their check on the back end once everything closes, and once we sell the property, you take your cut, I'm good to go. But at the same time, you have no credit on the line. You have no income history being stated. The bank, like your dentist is not going to be all in your financial records. You don't have to worry about that. So that's where private money comes into play. So those are your 4 basic financing techniques. But I want to show you the next segment is I want to talk about how or where you can find the cash. Because just because your hard money lender says, okay, we would like, and you can't do this with FHA, you can receive gifts as far as like monetary gifts, but they're going to want to see where that came from, and they're going to want to see that, like, if they all are included in the paper trail analysis. So where, you know, your hard money lender comes up to you and they're like, you have an awesome deal and we want 10% down payment. And say that's $100,000 purchase price, 10% of that, $10,000, and you're tapping your pockets like, I don't even have the $10,000. Where can you get the money from? There are a couple of places. First, and this is me just talking about where you can get the cash from as far as the down payment. And I have to start number 1 off like this. Number 1 is your own cash. It don't get much simpler than that. Your own cash. Another one is friends and family. Hey mom, hey dad, I have this awesome investment opportunity. Can you fund me $10,000? There you go, son. No problem at all. Take it and do good with it. bring me back whatever my stipulation is, and we're good to go, or I'll just let you borrow it and just give me the money back when everything works out in your favor. Friends and family, your business partner, whoever is in your sphere of influence that can lend the money from you, to you, I should say. 3, your IRA. I am not going to speak as your financial representative, your financial coach, your advisor, none of that. I'm only talking from a real estate advisor and a real estate professional standpoint, but you can pull money out of your IRA in order to fund deals. So if you've been an employee, you've been working, and you've been stashing some money aside every single month to your IRA, it's got, a decent, I don't even know if I can call it decent, rate of return over the years, and now you're sitting on a lump sum of money, you can pull that out. Number 4, credit cards. I mean, that's what the bank's doing. They're using your money against you to go invest in assets to bring them a return while they continue to grow their business, sucking you into the BS checking accounts or the savings accounts or anything like that. And could you imagine? Here, we'll put some things in perspective. If you had $250,000 in the bank, when you sign your checking agreement or your savings account agreement, there's fine print language that says, hey, listen, you can put as much money as you want in here, no problem at all. We'll keep it safe. But don't ask us for all your money at one point. Like, what? So if I had $250,000 in the bank and filled out a withdrawal slip, hand that to the teller and like, okay, I want my $250,000, they wouldn't even be able to give it to you. Or they might be able to give it to you and then it ruins the next person's chance at giving to it. The bank only has a certain amount of money in cash on hand. They're smart because the cash that they do on hand, called reserves, that's not your money. That's not your money. That's reserves. The money that you put in there, they collect the stockpile and then they go lend that out somewhere to make a return on investment on their money. So credit cards is a great opportunity for you to gain access to funds or cash that you wouldn't normally have. But Austin, credit cards, why would you dump more money onto your credit card balance? Because you're borrowing money to buy something that's going to produce you income. You're not spending this on a vacation. You're not using credit cards. Credit cards should only be used for 2 reasons. 1, to invest. 2, emergencies. That's it. That is it. Mind you, your credit card, ideally, you want it on the 0% credit card. Sometimes banks will send you the 0% APR promotion where you have no interest for 14 months, 18 months. Those are the best credit cards because now you're not even tacking on interest. That's just a placeholder. So if you take out $5,000 or $10,000 from a couple of credit cards that have 0% financing, you're not even going to be charged interest on these credit cards. You're going to pull out these money. It's going to show up on your bill as a placeholder. Sure, you might have to pay a minimum payment of, if you take out $10,000, I don't know, what's your minimum payment on that? I don't know, $200 a month, $300 a month, whatever the case. Once the deal is complete and you get your money back and more, just pay your credit cards off. Done deal. Easy access, most overlooked access to cash, and it's sitting in your wallet right now. If your credit is a little bit messed up, cool, no problem. You have all these other options while you work on your credit. Cool. Number 5, HELOC. HELOC. That's an acronym for Home Equity Line of Credit. If you have equity in your home, you will be able, well, not just a little bit of equity, usually 20% or more. The more the better, so you don't just leverage yourself all over again and just tack on more debt, more than what you need. But say if you had $100,000 worth in equity, you can take out a home equity loan, which at that point you take out, say, $20,000, $25,000, and use that to fund your deal. Once the deal is complete, you apply your proceeds, your initial proceeds, straight back to that balance, and then you collect all the profit. It's like you're playing with house money. You're playing with house money. Let me see if there's any others. Your accounts, your friends, your IRA, your credit cards, your home equity line of credit. Trying to think of anything. That's a good amount so far. But like, you have more options that you can possibly imagine. You just have to figure out how. And when you start investing, one of the major mistakes I made investing in the beginning, I've gotten a lot smarter, is I used to try to put deals together when there's a difference between not having money and investing in real estate, and then not having money but not knowing where the money's going to come from and investing in real estate. Does that make sense? You can invest in real estate with no money, but so that excludes everyone except for your own cash. You have to find out how else is it going to come from. I don't care if it came from a friend's credit card. You have to know ahead of time before you go ahead and set up your deal. I don't care if you're using friends or family. Fine, but establish that first. Don't find the deal and then start scrambling to find out where you're going to get the money from. I'm not saying that you're not going to be successful with that, but over the course of, say, 10 deals where you don't know where the money is going to come from, only 5 of those deals might get closed. Great deals might get closed. So the other 5 deals, the investor or whoever bought it to you, they might just think that you just can't get deals done, and that's going to hurt your reputation. So if you're not using your own cash, it doesn't matter. Find out where the money is coming first. If you have to have that conversation with friends and family, have it first. So that way, when that awesome deal comes into play, even if you don't have no money, you're ready to pull the trigger, and you're ready to have the funds accessible. All right? So that's my lesson for today. How to buy an investment property, how to buy your first investment property, how to buy your next investment property. You have a plethora of options here that are at your disposal. You just have to learn what tool is best equipped for you to complete the job. Obviously, if you have any questions, comments, concerns, issues, raise it to me. Visit AustinSmithRealEstate.com. Check out the podcast. Check out the blog. I'll be doing a lot more videos. And then whatever you need, I'm here for you. This is Austin Smith signing off. Austin Smith Real Estate. Let's make 2019 an awesome year. Deuces.